So far we have discussed about what are financial markets, and also we have understood what are the major functions of these financial markets. We have also had a peek into what are the primary financial markets, and now we are going to discuss about what are the secondary financial markets. So when talking about secondary financial markets, these play a very critical role in the facilitating of trading of existing financial assets. So the main securities which are traded in the secondary financial markets are the already the existing financial assets, and also they provide a platform for investors to buy and sell securities after the initial issuance, and it also contribute to market liquidity and price discovery. So to talk about secondary financial markets, they play a very major role in which providing liquidity and also price discovery of the securities. And while talking in detail about the secondary financial markets, the first point that we have to mention is the trading of existing assets. So in the secondary financial markets, in primary financial markets, we have discussed that is the securities which are traded are the initial public offerings mainly, which are the securities of the companies which are newly listed in the stock exchange. So these are being will be traded for the first time in the stock market. So such type of securities are being traded in the primary market. But when it comes to the secondary financial markets, the securities which are traded, they are already listed securities. So the exchange of these securities among the sellers and the buyers takes place in the secondary financial markets, rather than the in the case of primary markets where the securities are directly bought from the company for the first time. So that is the one point, and the next one is the facilitating liquidity. The secondary financial market, it provides a platform for investors to easily buy or sell their holdings in the particular company, and also it increases the liquidity of financial assets, making it easier for investors to enter or exit positions. So in a secondary financial market, what happens is like if I want to sell some of my stakes in a particular company, I can do that easily through a secondary financial market. So if I'm in need of some funds and I have this much amount of shares with me, I can easily share them. I can easily sell them and like finance my current needs for money. I can solve my problems of liquidity. So the secondary financial market, it facilitates liquidity and also price discovery. The second, how the secondary financial market is operating is basically the theory of demand and supply. Like whenever somebody it is basically working on the basis of the matching of demand and supply of orders. So the price discovery, the price is fixed basically by the force of demand and supply. So this is also a primary feature of the secondary financial market. And the next topic that we are going to discuss about these are the types of secondary financial markets. So while discussing about this, the first type of secondary financial market are exchanges. Or while talking about exchanges, these are the organized marketplace where securities are traded through a centralized system. Like there will be a particular regulatory framework, or a particular place or a virtual marketplace, like things which through which we can trade our securities which are we already have with us. It is an organized marketplace. The exchanges are basically the organized marketplace, and these are the things that we have regularly heard about, like the Bombay Stock Exchange, the National Stock Exchange, the New York Stock Exchange, and things like that. So it is an organized marketplace where our securities can be exchanged for money. So that is the exchanges. And the next one is the over-the-counter markets. These are the decentralized markets where trading occurs directly between two parties without a central exchange, often involving less liquid assets or specialized financial instruments. So over-the-counter markets are whereby they are central and decentralized markets. So there won't be a regulatory proper system like that. And the securities will be exchanged between two persons directly. So that is the over-the-counter markets, and uh, based on our order and supply of securities, there can be freely exchange between two parties. That is the over-the-counter markets. And the next one is the electronic trading platforms. So these are digital platforms that facilitate online trading of financial assets, offering speed, efficiency, and access to a wider range of markets and instruments. So electronic trading platforms they are basically exchanging of shares through online platforms, like through online digital platforms or things like that. So our securities can be basically, they can be exchanged electronically without being physically exchanging the shares. The mode of transfer of securities will be electronic or through internet. And the next one, we are moving towards the characteristics of secondary financial markets. So while discussing about the characteristics or the features of secondary financial markets, the first feature is liquidity. As we have already discussed, the secondary financial markets makes it so easy for you if you are in need of some funds, or you have that liquidity requirement now. You can easily sell off your shares and fund your requirements of today. So the secondary financial markets offers liquidity at the maximum is possible. And the next one is the price transparency, the availability of real information on prices and trading activity, allows investors to make informed decisions based on current market conditions. So in the secondary financial markets, you can see the actual data, like in the real time data of the company stocks moving, their prices and all of that. So you can actually that the transparency of prices is very much evident, so you can take decisions accordingly for selling or buying of your shares. So price transparency is another major feature when it comes to secondary financial markets. And the next one is regulatory oversight, the presence of rules and regulations governing the operation of secondary financial markets to ensure fairness, transparency, and investor protection. So secondary financial markets are guided by so many rules and regulations which guide the investors, or which helps the investors in having a safe having safe transactions, and also while at the same time they can satisfy the needs for liquidity by being safe, and as there is a regulatory environment, it's very safe to operate in secondary financial markets. And then next one, that what we are moving towards is the participants in the secondary financial markets. While coming to this, the first thing is the individual investors. So the retail traders who buy and sell securities with each other, who exchange securities with each other, they will be the primary participants in the secondary financial markets, as they are the ones who buy shares or exchange shares with which they have, those sell shares with others. So they are the primary participants. And the next one is the institutional investors, the large organizations, or apart from the private individuals who invest in the securities and secondary financial markets, there are also institutional investors like the insurance companies or multinational companies who park their excess savings with the like they invest in the secondary financial markets as a form of investment. So they are institutional investors. They might have a large amount of money with them to park with a certain fund or a particular to buy shares of a particular company. So they will have a large amount of capital with them for investment. So they are institutional investors who also participate in the process of buying or selling of securities in the secondary market. They are the next participants. And the next one is the brokers. The stock brokers or the exchange brokers. They're basically the middlemen who operate between the buyers and the sellers of the securities. So if I want to buy few shares, or I want to sell some of my shares, uh, I'm gonna place an order, or I'm gonna inform my broker that I have to sell my shares. So these are the men who uh, work in as a bridge between our sellers and buyers of securities. So they are the middlemen basically. And the next one is the market makers, the financial institutions that provide liquidity by consistently quoting bid and prices, ensuring continuous trading activity. These are the market makers who are the next participants in the secondary financial markets. And next one we are moving towards is the importance of secondary financial markets. The first point that we have to discuss here is the capital formation. Secondary markets encourage companies to issue securities, providing them access to capital for investment and growth. So the secondary financial markets, it acts as an encouragement for the companies to raise funds from the public through the secondary issue of shares and all. So it helps the company to meet its financial requirements, and it also motivates the companies to raise funds from the issue of shares and securities in secondary financial markets. And the next one is the economic growth. By facilitating capital allocation and investment, secondary markets contribute to overall economic development and prosperity. So economic growth, when we're talking about economic growth, when companies are in excess need of their funds for diversification or for expansion of the business, they can easily go to the secondary financial markets and raise their funds. They can raise funds from the markets with so much ease. So it is a economic growth. The secondary financial market promotes economic growth in a large extent. And the next one is the risk management. Investors, as we have already mentioned, there are a set of rules and regulations or the guidelines which are prescribed in the secondary financial markets, and there are regulatory bodies to oversee all of these. So it is basically very much secure and safe, and also the companies can anticipate their risk which they can have in the future, and also they can take remedial action. So it is a very efficient method for risk management for the companies. And the next one is the trading mechanisms in the secondary financial markets. The first one is the order driven trading. In this particular mechanism, orders are matched based on price and time priority, ensuring fair and transparent execution, often used on exchanges. So here what happens is, when an order is placed by a particular investor, they are being, if I have placed a sell order, my order will be matched with a corresponding buy order, and the orders will be matched in real time and based on the price and time priority, and based on this particular order driven trading is undertaken, and the buy orders are matched with the sell orders, and they are majorly used in stocks exchanges, as we have already mentioned. And the next one is the cord driven trading. Market makers provide bid and ask prices, allowing investors to buy or sell at lower prices, providing liquidity and facilitating fast transactions. So in a cord driven trading, the cords are being collected from the investors, and they're much more efficient and faster as compared to the order driven trading. And the next one is electronic trading. So this is basically the electronic trading which happens through digital platforms like online apps or things like that, and securities are exchanged actually through the digital platforms, which with so much ease and convenience. That is what happens in electronic trading. And the next one that we are moving to is the risks and challenges in secondary financial markets. The first one is the market volatility. Fluctuations in asset price can lead to losses for investors, especially during times of economic uncertainty or global events. So, just like any other investment method, investing in secondary financial market are also subject to market risk. There can be fluctuations or losses for the investors based on the market prices of the shares or the general conditions of the economy and things like that. And that is the first risk. And the next one is the fraud and manipulation. There can be very much fraudulent activities in the business, even though there are stricter regulations and things like that. There can be still fraud and manipulations in the secondary financial markets, which is also another risk. And the next one is the cyber security threats. Like nowadays things are getting a lot more done through the internet or using computer softwares and things like that. So there can be increased there can be increased cybersecurity attacks or virus threats and things like that, which are when the transactions are done or through the internet mostly. And the next one is the regulatory changes. As we have already mentioned, the technology is having a larger role in the trading activities today. So to keep pace with the changing technology and changing technological environments, there have been a large amount of regulatory changes that have been adopted in the markets nowadays. So the rules basically keep on changing with each passing days, which makes it even difficult for investors and also the other participants in the financial markets to keep in pace with the changing regulatory requirements that they have to follow while operating in the secondary financial markets. So we have had a brief detailed look into the secondary financial markets, its functioning and the types and its working and all of that. So as a conclusion, what we can say is secondary financial markets are essential for a healthy and efficient financial system, and it provides price discovery, liquidity, and capital formation for business and investors. While there are many risks and challenges which the investors in secondary financial markets can change, there are at the same time regulatory requirements and also so much rules and regulations which are in place in the secondary financial markets, which can protect the investors from any malpractice or fraud. So it is investors can harvest the benefits of secondary financial markets while keeping in mind of all of those risks and challenges that they can face in the secondary financial markets, and they can use the secondary financial markets and they can reap benefits out of it, like by uh, fund finding their liquidity requirements or also the price discovery. So they can what can actually be done is that secondary financial markets can be used as should be used as a form of investment, as a very best form of investment, while at the same time we should be having an eye on the fraudulent malpractices which can occur in the secondary financial markets. By keeping in mind all of these, we can have a better investing opportunity in the secondary financial markets. So that is all. Thank you.
Good morning, all. I'm Amal Baby, and I'm here to present about the topic financial markets, aiming to provide the definition of financial markets and the primary functions of financial markets. So, financial markets include any place or system that provides buyers and sellers the means to trade financial instruments, including bonds, equities, the various international currencies, and derivatives. Financial markets facilitate the interaction between those who need capital and those who have capital to invest. The key players of financial markets are investors, companies, governments, financial institutions, and intermediaries. Investors are mostly individuals and institutions. Uh, Also, companies issue stocks and bonds in financial markets in order to raise funds for their operating activities and to raise capital. Also, financial markets is divided into two, which is primary market, where where instruments are traded for the first time, like stocks and bonds, and the secondary market, where existing securities are traded among investors. So, these are the major functions of financial market. First one is facilitation of price discovery. Price discovery is the process of determining the fair market value of a security, commodity, or asset through the interactions of buyers and sellers in the market. Financial markets help in the facilitation of this price discovery. Second one is mobilization of savings and channelizing the savings into the most productive uses. So financial markets mobilize the savings from individuals and channelize these savings into companies who need funds for their operating activities in order to earn profit. So financial markets play a huge role in mobilizing these savings and channelizing these savings into the most productive uses. Third one is providing liquidity to financial assets. It means that markets facilitate buying and selling, enabling participants to convert assets into cash. And the last major function of financial market is reduction of the cost of transaction. Financial markets helps in reducing the cost of transaction to a very extent. This is due to the low transaction costs, information costs, and operation costs occurring to individuals and companies. So this is the presentation about financial markets, and I hope all of you understand about the definition of financial market and also the functions of financial market. Thank you.
Good morning, all. I am Tom John. I am here to present some introduction of primary market and the instruments and the players in primary market. So, first of all, what is primary market? Primary market, where a part of financial market, are issued new securities and sold for first time. This is where companies and governments raise capital through sales of stocks, bonds, and other financial instruments to raise the capitals of the company for the production and growth for the companies. So we come to the instruments. There are three types of instruments. Basically, first one is equity, debt, and derivatives. So coming to equity shares. Equity shares, when a company goes public, it issues shares in the primary market through IPO, initial public offering. Investors who purchase these shares become part of owners of the company. Recently, we know that their Bajaj Housing, They issue IPO at at 75 rupees at of initial, but the market will boom the price, and the coming in, and finally in the IPO section the price of the budget housing being 175 at all. So equity is one option to raise capital. So the second one is debt. It represents loan to a company or government, promising interest payments and repayment of principal. Example like bonds. That is issuing bonds to raise long-term capital. Investors buy these bonds and return and receive periodic interest payment and the principal back at maturity. So they are being receiving the investors in interest payment on a periodic basis. So the third one is derivatives. Coming to derivatives, financial instruments whose value depends on an underlying asset such as stock, bond or commodity. Such means derivatives is it's a compounding factor, because in derivatives there are stocks, bond or commodity, on all the underlying assets being depend on derivatives. That's the three instruments in primary markets. And coming to equity primary market, for first of all I told that in IPO, initial public offering, the first time a company sell its shares to the public often raises significant capital. A company wish to raise the capital of a capital, they they doing issuing stocks by in the form of IPO. And secondary offering, when a company already publicly traded issues additional shares to raise more capital. In example like such companies Reliance, they issue stocks recently, and then they add new additional issue shares for what? For raise more capital for the production and growth of the companies, and the investors are wish to buy their stocks. And the second final part is rights offering. Existing shareholders are given the right to purchase additional shares at a discounted price. So they are an opportunity for excited shareholders to purchase the additional shares at a discounted price. So equity prime in equity in prime markets, such the 3 points are mainly conducted. To coming to debt in primary market, the first one is corporate bonds. First of all, I tell that bonds be issued, and in a based on a periodic terms, they be an interest paid. Such type of this is bonds. In first of all, corporate bonds. Corporate, the companies issued to finance operations, expansion, or acquisitions. For companies which issue bonds, most of all the what the for an financial use or operations or productions. So coming to government bonds, the government issue to finance public spending for infrastructure projects or debt management. In government affect any debt or any financial crisis, they issue bonds to the public, and they receive the money the investors which would feel, and the debt being managed with some price. So government bonds being um, issued most for based on debt management or for infrastructure projects to complete the projects. And third one is municipal project issued by local governments, municipalities or state agencies to fund infrastructure or public project. It also same to the government bonds. The bonds being issued by local government or state government which complete the infrastructure projects or public projects or any such types of projects they need wish to raise the money, so they issue bonds. These are we in based on debt primary markets. In coming to the players in primary market, what are the roles of the players in primary market? The first one is the first player or the first user is issuers. First of all, companies, governments, or in other entities, they sell their securities to raise to public for raise capital. The first player is issuers, and the second one is underwriters. Investment banks that helps issuers to sell securities to investors taking on a risk of unsold securities. Underwriters play a major role to help issuers to sell securities to investors taking on a risk of unsold securities. They take a risk on unsold securities to help the issuers. So the coming to the third player in primary market is investors. Investors like individuals, institutions, and other entities that purchase new securities in primary market. They issue money and purchase the securities which is issued by the government or companies or other institutions. Coming to the last one is regulators. Regulators which the, like an agency that controlled by government that operation of primary market that conduct operation of primary markets to ensure and fair and transparent trade being conducted in there. Like example like SEBI, SEC, like Securities and Exchange Commission in US. In India, this means SEBI, as is also known as Securities and Exchange Board of India. So regulators they ensure and fair and transparent trading is being conducted in the primary market. So the major players in primary market are issuers, underwriters, investors, and regulators. So primary market regulations. Primary market regulations aims to protect investors, maintain a fair competition, and ensure market integrity. Regulations often require issuers to disclose material information and ensure proper underwriting practices. There have been regulators like SEC in US, Exchange Securities and Exchange Commission, and FCA UK, ESW, ESMA in Europe. These are some types of regulators which conduct in different countries. In our country, in India, we know that SEBI is the regulator that they they wish to protect the investors and issuers to maintain a fair competition. So they wish to keep a fair competition conduct in the primary market. So the regulators being important in primary market. And coming to the pricing and allocation in primary market, pricing and allocation of securities of primary market are crucial for ensuring fairness and efficiency. Underwriters play a significant role in setting price and allocating securities to investors. So we realize about the underwriters. So investors or financial institutions, such types of people or big group of team, they been crucial. They been ensuring they been maintaining the stock price. They play a significant role in setting prices and allocating securities to investors. So, in coming, there have been three parts being mentioned: book building, allocation, pricing. So, in on the basis of book building, it's a process of gathering investor demand for securities at different price to determine the offering price. And in base of the allocation, a distribution of securities to investors based on their bids considering factors like size and type of investor. It's been considered on the size and type of investor. And coming to the third part of pricing, the final price at which the securities are offered to investors determined by balancing supply and demand. So these were the three major concerns to allocating and the pricing and setting. So the coming to the conclusion, capital formation, investor opportunities, regulatory oversights. There been capital formation is being conducted formally and fairly based on the regulators. Investors have a big opportunity in primary market. They provide investors with access new and potential lucrative investment opportunities. So investors have a big opportunity to provide invest in the new stocks and new securities which to be given more growth in future. A regulatory oversight also means SEBI is controlled in India in all the base of India. SEBI is under control of the primary market, and with that it's been fair and we conducting transparency market trading. So that's all. In summary of a primary market, they play a vital role the flow of the funds for investors to entities that need capital for expansion, innovation, or to complete the projects. These markets are foundational to overall capital market system, enabling investment, economic growth, and development. So that's all primary market. Thank you.
So hi everyone, I am here to present about regulatory bodies in Indian stock market. So first of all, we have to know about that what exactly is stock market. So stock market is a complex system that ensuring fair play in investors protection. So by this presentation, we have to discuss about what are the different type of agencies that are regulated in Indian stock market. Those who are control the stock market affairs, etc. So the first one is Security and Exchange Board of India, SEBI. So that plays a crucial role in the stock market. They also deal with the mutual fund and all the activities related to stock market, and also it ensures the protection of the investors. Second one is Reserve Bank of India. As we all know, Reserve Bank of India have been a crucial role in the financial institution and banks. So the Reserve Bank of India doesn't have a direct impact in stock market. Meanwhile, they have an indirect impact among the stock market. So next one is Ministry of Corporate Affairs, that is MCA. Their corporate governance means MCA ensures compliance with the corporate governance standards, promotes transparency, accountability of listed companies. The only accountable for the listed companies is stock market. Next one is that financial reporting. MCA's role in overseeing the financial reporting standard ensures accurate and reliable information for investors, promote transparency and trust in the market. Then there are companies laws. MCA roles enforces companies laws regarding the functioning of companies, impact the behavior in stock market. Next one is the stock exchange, that is NSE and BSE. NSE means National Stock Exchange, that headquarters in Mumbai. It is the largest stock exchange in India in terms of trade volume. Next one is BSE, that is Mumbai Stock Exchange, the oldest stock exchange in Asia, and their trading platform NSE and BSE provide trading platform in investors buy and selling the securities. Then their regulation, both exchanges are regulated by SEBI, and rules and regulations ensure the transparent trading environment. Next one is roles and responsibilities of regulatory bodies. First one is investors protection. Ensures a fair practices and preventing from frauds and other malpractices. That is the first roles and responsibilities towards each stock exchange regulatory body. Second one is market integrity, maintaining a level playing field, promoting transparency and preventing insider trading. And market efficiency, that is facilitating smooth trading, price discovery, and liquidating, fostering a vibrant and effective market. So last one is compliance enforcement, monitoring compliances with the regulations, investing violations and imposing penalties for misconduct. I hope everyone who understand about what exactly the stock market and the regulatory bodies in Indian stock market. Uh,
Myself, Gautam V. Subhash, and today I'm going to talk about the topic personal finance, roadmap to financial wellness. We know that personal finance is something that most people underestimate because a lot of people doesn't know where to invest and on how much amount to invest to gain a profit or be stable financially. And financial investment is something or a topic that should be talked about. So unnecessary spending is a problem among this generation because based on the social media, because of the social media and a status seeking problem, because people spend their hard earned money on these high end clothes, cars, and things that basically doesn't matter, materialistic things. So usually the poor people make these poor decisions. Their hard-earned money is wasted in a ways like this. So today we are going to look at some personal finance tips, and I'll be sharing about it. So the first point is budgeting and expense tracking. So track income and expense. Monitor your income and expense to gain insight into your spending habits because most of the people spend more than what they earn. The expense is higher than their income. If we look in the case of a teenager boy recently bought an iPhone 15 Pro Max with the EMI on it, but he couldn't pay the amount because he doesn't didn't have the income to pay it, the EMI. The situation is like that because of the show off on social media. People think that buying an iPhone is greater than saving money for the future. It's all that want. So it's a status epidemic, and the expense is higher than the income. So we should monitor what is our income and what is our expense and maintain it. We should then create a budget, especially for things like medical expenses, shopping, basically mainly on shopping, because we shouldn't spend more than our 10 percentage of our monthly salary on shopping for our personal mindless shopping, because for grocery and food items, the essential things are on other part. uh, we should budget for that separately. But in the case of unnecessary shopping, like there's a off for this particular shoe on this shop, then we should buy it. That's not necessary for you now. You have many shoes but you are still buying that, and without any reason because there is a offer, then that's an unnecessary spending. So we should have a budget on that. It shouldn't this shouldn't cross more than a 10 percentage of your monthly salary or income. Then we should categorize expense. Okay, the categorizing expense helps you understand where your money is going and identify the areas to improve. Categorizing expense means we should find out where you spend the more. If you are spending more on these useless things, then the expenses should the budgeting should be maintained. It can help in creating a budget. Categorizing expense can help in creating a budget because we will have an idea on what we are spending. So that will in turn help us. Then the fourth point is use budgeting tools. Okay, budgeting apps and spreadsheets can help you automate budgeting process and make your managing your financial decisions. Okay, so the things like spreadsheet, it's a little bit advanced, but there are uh, But there are apps which are used for personal financing, and we can take Notion as an example. Notion is not basically a finance tracking or budget tracking application, but it can help in maintaining our lifestyle. So in turn, tracking budget and maintaining our financial position. So let's get on the next topic, saving and building an emergency fund. Why save? Saving provides financial security and helps you achieve your long-term goals such as buying a home or retire comfortably. Unexpected expenses, financial goals, investment opportunities. Why you should save is an question. It's a controversial question, we can say that. Why we should save? Because basically savings can meet our unexpected expenses. Because if suddenly a medical emergency comes up, it's basically our second point, because emergency funds are used for medical expenses and all, but the savings can also be used for that, or we can achieve financial goals or our dreams, whatever it is, to buy a sports car or to buy a house, to buy a property on this particular area. We can use that savings for that, and the savings can yield a high interest rate throughout the years. So it's a investment opportunity basically. And then it comes to emergency fund. An emergency fund acts as a safety net for unexpected events such as jobless or medical emergency. Job loss or medical emergency. Because there will be a situation when 6 to 7 months of living expenses can be covered due to with this emergency fund, because we know that during the pandemic many of the peoples were financially struggling because they didn't have any savings or any emergency funds. On the other hand, the people who had emergency funds or some things on their bank accounts, they saved for times like this. The people who predicted a time like this would come, basically not pandemic, they would have assumed that they would lose their job and they would need money for at least a 1 year. So the people who saved money were living a good life during that time. It's an example. A COVID situation was example for that. And the high yield savings account, because we are investing in emergency fund monthly, there will be a high yielding saving fund. The rate will be higher for us. Then easy access. Basically, emergency funds are the budget that we are separately saving for a particular purpose, like a medical or job loss. It's a fund that will only touch if we don't have any other ways to deal with it. Then the saving strategies. Develop a saving plan that aligns with your financial goals, considering aside a percentage of your income for savings each month. So basically, saving strategies, every person can develop their own saving strategies. We don't need to follow any other entrepreneurs or any other big people's strategies on savings. Yes, common man can also develop saving strategies just by looking at their financial expenses, their desires and their goals for the future. So developing a saving strategy is also an important thing in personal finance. Then it comes the debt management and repayment strategies. So taking debt is something that has been with the humans since a long time, because during a frustrating situation where there is no money for us to satisfy our needs, we are forced to take debts. So in case of that, taking debt, make a list of your debts, including balances, interest rates, and minimum payments. We should be in track of what we are dealing with. Then we should prioritize repayment. Consider strategies such as avalanche method or snowball method to pay off debts efficiently. Basically, repayment of time can avoid a stress or headache for a month. So it's also a main point. then negotiate with creditors, explore options for lower interest rates, reduced payments, and debt consolidation. Then next point is to avoid future debt. Develop healthy spending habits and avoid taking on more debt than you can manage. Some taking the people make mistakes in the past, but we should learn from them and invest, and we should avoid taking debt in the for the future. It's the best decision we can use for we can do or take for the personal finance, because debt is the main enemy of this personal finance. So the next slide is investment from long term. So there are a lot of investment in the market. There are gold investment, stock investment, land investment, intangible investments, tangible property assets investments, and there are a lot of things like that. So this is a diversified market. So investment you also should be like that. Diversify investments. Spread your investments across different asset classes to reduce risk and maximize returns. And the second point is to set financial goals. Determine your investment goals such as retirement planning, buying a home, or paying for education. As human beings, we work for achieving something. We work in a job to get the salary. Just like that, we for work for a particular thing, for a particular goal. So setting a financial goal can also be a long-term investment. At the same time, it can be a motivation to work and maintain our personal finance. Then choose investments. Consider different investments options based on your risk tolerance, time horizon, and financial goals. For an example, for a rich person, investing in a multinational company with a huge amount is not risky, and if a loss comes, he can tolerate it. But a poor person in investing in a company with a huge amount by taking loan from the bank and investing in them, that's a big risk he is taking. If the company is on loss and the market goes down, the person has no other options to pay the bank loan he has taken to invest in this particular investment. So choose investment wisely based on your risk tolerance, time horizons, and financial goals. Then the other one is monitor investments. Regularly review your investment portfolios and make adjustments as needed to maintain your desired level of return and in risk and return. So monitor investments, investing in reviewing your portfolio is something that every person cannot do. So for them, investing in what investing in mutual funds is a good option. People who are busy, investment in funds like mutual funds are better for them. So that's all about long-term financing. Then the retirement planning and preparation. Retirement is a part of life that everyone has to go through. So from the young age also we should considering planning for retirement. We should reserve some amount for our retirement life. So basically it will be our last few years of our life after retirement. For most people, there are people who is taking early retirement such at 40 years old and like that. But for the people who are working until 56 or 60 years, after retirement years will be their last year. So the retirement planning is something that have been looked upon, because estimate retirement needs. You should consider what lifestyle you should live after the retirement. If you don't need a much luxury lifestyle, you should not consider investing or saving money for the retirement. Spend them at your young age and live your life. If you want a luxury life at your retirement, then you should consider saving the money. Then the second point is choose retirement saving vehicles. Consider options like 401ks, IRAs, and Roth IRAs, both on tax situation and investment goals. Then contribute regularly. We should consider maintaining entire funds and invest every month on that fund. Review and adjust. Periodically review your retirement plan and make adjustments as needed to ensure you are on track. Then the next protecting your finances with insurance. Uh, Types of insurance. There are a lot of types of insurance: health insurance, life insurance, disability insurance, like that, third party insurance for vehicles, a lot of insurance. The from the early ages also, early ages means a few 10 years back, so our parents generation, they consider this insurance as, most of the people consider this insurance as something as an expense, that is unnecessary expense that is taking. But on reality it's an investment that we are making, because as poor people or middle class family, they don't have the money, or they don't have the financial stability to tackle or survive a unforeseen accident or unforeseen events that come with a lot of financial damage. If in case of a poor family, if the man of the house or anyone of the family member gets a dreadful disease like cancer, the expenses for treatment will be very high, and they wouldn't have the money to treat them. So having a life insurance or having a health insurance can help in covering the hospitalization bills and treatment bills. So that's it. That's for health insurance. Then the homeowners insurance can protect your house from theft, fire, and destruction by natural uh, disasters. Then the auto insurance covers you from the accident of your vehicle. Disability insurance, if the disabled person cannot work for long time, then the insurance will cover the expense of that person. Then the life insurance, if a person is died by some accident or any other reasons, the during the time period of the insurance, the insurance will get by the wife. So, as conclusion and takeaway points, we should consider financially planning. We should save regularly, budget effectively, and invest for the long term by planning essentially. By financially planning essentially, there should be a plan for everything we are doing, and as I said, in case of the debt taking, the past are lessons we should learn from, and the future are the fights or battles we should implement that lessons. So we should plan everything and save regularly and budget effectively and invest for the long term. Thereby I conclude the tips for personal finance. I hope the class has been understanding. So thank you.
Hello, I'm talking about the emerging trends in financial market. The financial landscape is undergoing a rapid transformation driven by technology advancement and evolving investor preference. These trends present both opportunities and challenges for market participants. Second one is cryptocurrency and blockchain. Cryptocurrency like Bitcoin and Ethereum have captured global attention, offering decentralized, secure, and transparent financial system. Blockchain technology. The underlying technology behind cryptocurrencies is disrupting traditional financial process. And next one is artificial intelligence and machine learning in finance. AI and machine learning are transforming financing services by automating tasks, improving decision making, and enhancing customer experiences. Algorithmic trading. AI are used to execute trade at high speed and frequency, taking advantage of market. And second one is fraud detection. Machine learning models are trained to identify suspension patterns and prevent fraudulent transactions, improving security and companies compliance also. The next one is personalized financial advices. AI-powered robo advisors provide personalized financing guidelines. Next one is the risk of fintech and digital banking. Fintech companies are disrupting traditional financial institutions by offering innovative digital-first solutions, improving efficiency and accessibility. First one is mobile payment. Mobile payment app like Apple Pay and Google Pay have become simplifying and speeding up transaction. Second one is open banking. Open banking initiatives allow customers to securely share their financial data with third-party apps, enabling personalized services and greater control. Third one is digital lending. Fintech platforms provide alternative lending options, leveraging data analytics to assess creditworthiness and offer faster and it's more flexible loans. And environment and social and governance investing. ECG investing priorities companies that demonstrate strong environment practice, social responsibility, and good governance, reflecting growing investor concern for sustainable environment. Companies with low carbon emission, sustainable practices, and responsible resource management are forward. And social. Social investors consider companies with ethical labor practice, diversity and inclusion, and responsible product development. Third one is governance. A strong governance is very important. So companies with strong corporate governance, transparent operation, and ethical leadership are deemed more attractive. And its future of trading and investment platform. Trading and investment platform are evolving to provide seamless, personalized, and data-driven experience, leveraging technology to empower investors. First one is AI-powered insights. Second one is automated trading, and third one is fractional investing. And regularity changes and their impact on financial market. Regularity changes play a crucial role in shaping financial markets, addressing emerging risks, and protecting investors and ensuring market stability. Uh, and three key points are given. First one is cyber security, second one is financial inclusion, and third one is sustainable finance. And all about the emerging trends in financial market. The financial landscape is dynamic with emerging trends shaping the future of investment and finance. Understanding the trends is crucial for navigating the evolving market landscape and capitalizing on opportunities. This is all about emerging trends in financial market. Thank you.